You're the owner of a small business, which means you're also the tech guy, and HR, and personal assistant, and head honcho, and intern. You could use another pair of hands, like the experts you'll find at Verizon Small Business Days, April 21st through 27th. Get a free tech check, special deals, and more. Call 1-800-483-4428 or visit verizon.com/smallbusiness to book your appointment. Verizon Business.
Reality radio for a really great future. We're talking real money.
Well, look at us. We actually made it through the 2020 Christmas holiday unscathed. And here, alive and well fed with at least one of us with grape nuts. Well fed with grape nuts.
That's true. I'm gonna be well fed with grape nuts for a long time.
Got to tell you, this is just a great story. Before we even give you the phone number, Tom loves grape nuts. The original grape nuts, the crunchy chunks that break your teeth. Those grape nuts.
I do. I love those things. Yeah.
He loves
Delicious.
grape nuts. You know, and if you'll notice, he's got no molars, but he loves his grape nuts. So he goes to the store like every day, wandering the aisles going, "Any grape nuts, sir?"
And they still have the tag up there every store you go to that says grape nuts. Then you look and there's nothing.
Does anyone have grape nuts
shelf.
for a poor soul on Christmas? May I have more grape nuts, sir? And nobody has grape nuts. So what he did one day is he goes, "Hey, Don, you're good on the internet. What the heck happened to grape nuts?" So I look around. I don't know. It turns out there's a national grape nut shortage. Who knew?
But there's nothing written about it.
I found a little written about it. Not a lot. There's some. But there's a national grape nut shortage. Apparently, the two things that people need most in a pandemic is toilet paper and breakfast cereal. If you have toilet paper and breakfast cereal, you're set. And, grape nuts, you eat those things, they sit there for a week.
Probably true.
So anyway, Tom wrote a note to Post. They said, we're having a little grape nuts problem. For Christmas, yesterday morning, Tom wanders sleepily down the stairs, strolls over to the tree and looks underneath. And Santa, what does Santa bring? A case of grape nuts.
Can you believe that?
I'm so happy Santa was looking out for you, Thomas.
You know how long I'm going to be eating grape nuts now? I told my daughter, you better hope I live, because if I don't, you got to
eat the grape nuts.
Years. I know. No one else will touch those things, so you better get with it.
I hope all of you got your special grape nuts, too. 855-935-TALK is our phone number, 855-935-8255. We don't normally talk about grape nuts, but it's a holiday, so we figured we could. We generally talk about money, and we talk about how you manage money and how you can better manage money and some of the things you do that sort of mess up your financial life. And one of the things you do is you ruminate. You do. You kind of sit around and go, oh, like we did yesterday, or day before yesterday when we were worrying about Tom's grape nuts. Oh, there are no grape nuts in the world. What are you trying to do? Were you playing music?
No, that's my text sound. I forgot to turn off the phone.
Hear this.
Sorry. Yeah, that's a little trumpet. Yeah, comes on. Mm-hmm.
Yeah, little trumpet.
Yeah, here's the thing. I get to see the business end of what you just said a lot.
You get to see the business end of what? Which horse?
Well, of people ruminating, people worrying, people considering, I'm nervous, because I got one this week, said, not ready to invest this year because too nervous about the current market right now. Not ready to invest this year because too nervous about the current market right now.
I'm going to turn over a new leaf in the new year, and it's almost here, so I'm going to do this first. I'm going to take a deep breath and center myself before telling all of you that is the dumbest thing to think. It really is. You go ahead. You tell them why.
Well, okay, first of all, your portfolio should be about you. It has nothing to do with the current market. Current market totally different next week. The week after that, those things come and go. You should have your portfolio designed for the return you're trying to get within the volatility you're going to take. It has nothing to do with new presidents, care packages, whatever it is. That's a silly thing to base it on. Correct.
I was yesterday. The only person that I can see who's in my pod, it's my wife and my daughter. And my wife already knows everything, I think. So we can't, we don't discuss money. But my daughter was going, I should get into Bitcoin. And we're going to talk more about Bitcoin a little later. But what she was saying is, I said, it's way up. She goes, well, why don't I just wait till it goes down and then buy some and then sell it when it goes up again? And you see, there's a problem with this. Nobody tells you when it's done going up or when it's going to start going up again after it goes down. You will not know that, no matter how smart you might think you are. And remember, you think you're a lot smarter than you are. No offense.
Tom and Don are talking real money.
You know there are a few things more important than planning for retirement, but it does seem complex and convoluted. That's why Tom and I created Retire Meet back in 2015. This year, thanks to COVID, Retire Meet is going both virtual and national. And since you'll be doing your own catering, it's absolutely free. All we ask is that you sign up in advance at retiremeet.com so we can make sure we have enough capacity for everyone. This year's lineup will be our best ever, featuring experts on retirement investing, income generation, Social Security, long-term care, senior housing, estate planning, and more. Of course, Tom and I will be hosting. The consumer man Herb Weisbaum will be there, and we'll be presenting a huge double keynote address featuring both Paul Merriman and Dimensional Funds founder David Booth. Since you can sleep in and even attend in your pajamas, there's no reason to miss Retire Meet America 2021, so reserve your free tickets now at retiremeet.com. That's retiremeet.com.
For your real life and real future, Tom and Don are talking real money.
Hello there. Welcome back to our little get-together. We're actually here on the day after Christmas because we have nothing else to do. Except eat grape nuts. 855-935.
No, I was just going to rewrite the song Grape Nuts Roasting on an Open...
that is even worse than dad humor. I'm sorry,
well, it is dad humor.
It is dad. You're right. It's dad humor. 855-935-TALK. Give us a call. We'd love to talk money with you, as we're going to do with Matt. Matt, welcome to the show.
Can you hear me, guys? Greetings.
Yes, sir. Greetings.
Okay. All right. I'm on duty right now. So what I'll do is I'll tell you exactly, see if you can give me help on this.
Wait. Are you a police officer?
Yes.
If you get a call, can we ride along?
Yes.
I'm joking. Okay, go ahead, Matt.
Talk about bad dad joke. Go ahead.
Sorry. Okay, the main thing is this, and then I'll leave the phone here, and then I'll hear on the radio. Number one, is it, and you were talking about Bitcoin. Well, as dumb as I am, I would never go to Bitcoin. I hope nobody else does either. Is it really what's the best thing to do when you rebalance? I'm mostly with Vanguard, and I have mostly index funds. When you rebalance, is it smart to go before the end of the year or the new year? And since I'm in mostly Vanguard index funds, there's 3 select funds, and I'll give you the abbreviations here, and get your opinion on these. One is Fidelity Select Healthcare, FSPHX. I'll say it again. FSPHX. The next one, Matthews China Investor, MCHFX. MCHFX.
Okay.
The last one, ETF, iShares FSG, and it's SUSA. SUSA. So there you have.
And what's that one hold?
Funds.
I got it.
And your opinion on those 3 select funds and rebalance, end of the year, first of the year. I'll let you go, and I'll hear on the radio. Thank you, gentlemen.
Thank you very much.
You start with the rebalance.
You start with the rebalance. I'll do the funds.
Yep. Matt, thank you for your service, too. All right, so here's the thing on the rebalancing. It doesn't matter. And by the way, I want to point something out. Rebalancing, generally, you should be very careful. This is in a taxable type of account, not if it's in an IRA, no problem, because you don't worry about taxes. When you get into a regular brokerage account, you need to pay attention to this because you don't want to be selling a lot of things that could create a tax hit. In that case, maybe you do want to wait till next year, just pushing those taxes down the road. But there is no better time of year for all of this. I think annually is great if you're doing this on your own. Remember, most of the time you want to buy or sell the things that have gone up and buy the things that have gone down, get back to the correct percentages that make up your portfolio. But there is no one time better than another when it comes to rebalancing.
Now, I'll do the funds. Let's start with the healthcare. Let's start with just some general perspective on specific sector style investing. We fervently disbelieve in the concept because what you're doing is you're betting on a sector and you're actually thinking that you're going to outperform or outguess the experts on Wall Street. Whatever fund is doing today is what its fair price is. That's what its fair price is. Healthcare is fairly priced based on the situation, not only today, but the one that we expect in the future. Healthcare stocks are fairly priced. You will not likely win by betting on the healthcare sector. Same thing with China. China's shares are fairly priced. The other problem with betting on a company or country like China, company too, is the fact that it is actually a very small market. There aren't a lot of stocks in that market. It doesn't make up a huge percentage of the global equity market, and it's sort of a fringe market. It's very volatile, very, very risky. And finally, the last one, the SUSA, the iShares, that's an ESG portfolio. Which means it's a social responsibility portfolio.
Environment, social, government. Yep.
Yeah. It's a tiny fund. It really only has 200 securities in it. So it's a very limited ESG product, and I think you could probably find better ones.
Yeah, and just to close the book on these things, healthcare, again, you're making a bet on a particular sector. This is how I look at it. You're saying that's going to make more than the whole market over time. Nobody has any idea. By the way, healthcare had a great run in the 2010 through 2020. China has had a great year, by the way. Both Chinese stocks that are traded on American exchanges and Chinese stocks have had a great year. So you're going to look at that and say, I got to own that. Well, again, you own a global portfolio. You do own that. ESG, as you mentioned, Vanguard's got some very fine products. Dimensional Funds has fine products. There's others that could do this in a way that would be far more diversified than 200 stocks.
That's the key. Far more diversification. And let me tell you, Matt, real quickly, what you're doing is exactly what we were talking about at the beginning of the show. You are looking at what has done well and projecting that performance forward. China has done well. Healthcare has done well. That is no guarantee they're going to keep doing that. In fact, there is no guarantee. There is no even high degree of certainty that that will continue. So you're better off just being massively diversified and don't try to beat the market.
And we give you 3 fund portfolios at Fidelity, Vanguard, and Schwab at TalkingRealMoney.com. Don's just redone the website. It's beautiful. You can go there and find those portfolios.
You can find them easily now.
And build it correctly and not make bets on particular sectors as we head into the new year.
855-935-TALK is our number, and Chris is next. Welcome to Talking Real Money. Hi, Chris.
Hi. So pretty soon I'm going to start working for a company that has a mega backdoor Roth conversion. I've read the basics about it. I'm interested if there's any gotchas or what you have to say is the strategy I should go for that.
So what you're talking about is the fact that you'll be able to, instead of saving, and how old are you, Chris?
I'm 56.
56.
So I am doing I am doing the full 401k and the makeup, and my understanding is that I would be able to additionally contribute in excess $15,000 into the 401k that then I would have to kick over and convert into a Roth post-tax, correct?
That's the back. That's the back door.
Yep.
That's the back door.
Supercharge.
Yeah.
I think it's wonderful. I don't know of any tricks to it. I think it's just a great a great thing that your company's offering you. If you're able to do it, that's terrific. And again, then when you retire in hopefully 10 years or so, you're going to have more post-tax money you can use to live on. I love it.
It's hard to find a downside except the fact you got to pay taxes on it, but that's the way it would work anyway. So, it sounds terrific to me. Thanks for the call, Chris. I'd do it if I had the dough and was really trying to supercharge my retirement, which is a wise thing to do. 855-935-TALK's our number. Call. We've got lines open.
Tom and Don are talking real money.
Is your portfolio a mess? You may have a case of hodgepodgeitis, but don't worry, we can help. Just set up a free, no-obligation meeting with a Vestory advisor at Vestory.com. No sales pitch, guaranteed. That's Vestory.com.
Your guides to a really great financial future. Tom and Don are talking real money.
And you know Bitcoin is up to like $26,000 ridiculous dollars?
Oh, help us now,
I mean,
please.
really. I mean, think about it. 2 years ago, it was $3,000. A few months before, it was $3,000. It was $20,000.
It went to $20,000.
It went to
$20,000.
Then it went to $3,500 or something. Now it's back up to $26,000. That's just volatile. That's the epitome of volatility, folks.
Wild ride like this since my first marriage. This is crazy. So, no, I wouldn't do it.
Wow. I don't even know how to take that one. Thank goodness I don't know how to take it because the visuals would just be disturbing. 855-935-TALK is our phone number. Call and help us out. And I'll just grab one of the questions that people have sent in at talkingrealmoney.com. They type them. People love typing questions. I don't understand. Anyway, subject, Roth IRA for my 20-year-old son. Here you go. You ready, Tom? Mm-hmm. Looking to get my son Jack into an IRA as a retirement vehicle. He is sitting on a pretty good chunk of cash in his savings account from wages while he lives at home and attends college online for the time being. We have a Merrill Lynch advisor who manages my father-in-law's investments, and she recommends
what?
MFECX Growth Fund with a whopping here,
how much?
Let me tell you, I'm trying to remember what the fund is. It's an MFS Growth Fund, I think. MFS. What did I say it was? MFS. MFECS. MFECX. ECX is the MFS Growth C shares.
Oh, yeah. Let me just guess on the expense ratio prior to this lovely C.
Yeah.
That's probably 0.5% or something, right? I don't know.
No.
Plus.
Try 1.66.
Oh, for God's sakes. Come on.
Yeah, he goes on to say, I think this is too much for a young kid to pay over and over again because every time you put money in,
it's
forever.
too much for an old person to pay because that's a ridiculous. All right, I'm going to go with
this will be an
VT for victory. VT for victory.
Yeah.
That is, and you can get, so VT is an exchange traded fund operated by Vanguard where you own the whole world, 9,000 stocks, and I think it's 8 basis points. Now you compare that to 1.5%. I can't do the math. I'm not smart enough to do it.
1 2/3%.
When you throw the
really, the difference is a little over 1.5% a year. So all the Vanguard fund has to do is it can actually underperform by 1.5% per year and still do better than the MFS fund, which isn't likely to happen. And this illustrates, though, one of the problems with stockbrokers, that Merrill Lynch advisor and many others, is in their zeal to sell you a fund that appears to not have a 5 3/4% commission going in up front. They sell you what is called a C share. A C share is a sneaky load share. They are still going to get their 5% commission. They will get their 5% commission. You just won't know about it because they're getting it paid back through the extra 1% or 3/4% or whatever it is in the 12B1 fee that's tacked on. It's a gimmick.
And for the life of, I don't know why anybody would buy that fund, but for a young person, that is a horrible decision because, as he said, you're not just paying it today, you're paying it tomorrow, you're paying it on and on. Instead, if you buy that incredibly inexpensive exchange traded fund at Vanguard, You're owning all those stocks. For a young person, it's absolutely a perfect setup. The growth potential is phenomenal, and you get it for almost nothing.
And here's
no comparison.
Here's an idea for you. Since this is your father-in-law, you want to be in good stead with him, right? But you don't want to tell him he's wrong about using Merrill Lynch. That's just going to get you in trouble. So instead of doing that, you should say, "Hey, Dad-in-law, I've been listening to this show on Como or this podcast, Talking Real Money, and you're interested in investing. You probably should listen to it too. We'll take care of it from there."
Tom and Don are talking real money.
Learn about estate planning, Medicare, Social Security, senior housing, investing for retirement, generating income in retirement, and protecting yourself from consumer scams, along with a special keynote duo, Paul Merriman and David Booth, the founder of Dimensional Fund Advisors. Reserve your free place now at retiremeet.com, retiremeet.com.
Reality radio for a really great future. We're talking real money.
Yo ho, how's your dough? I'm Don. Welcome to the show. That's Tom over there. This is Talking Real Money. We just want to talk with you about, well, your real money and how you deal with it. 855-935-TALK is our phone number. 855-935-8255. Give us a call. We got lines open, and we're actually here. I don't know why my daughter.
And many of you
like
to.
Me.
Many of you like to write us instead because it feels more comfortable. We're happy to. We can do that. By chat? We can do that by going to the website. All kinds of other ways. Everything okay with your daughter?
Yeah. They're just setting up my wife's new Apple Watch I got her. And they needed
Apple Watch. Can you make a watch out of an apple? I never have understood that, but okay.
Well, it's pretty cool, actually. It's and it's organic. It's an organic apple.
But if I'm going to go for an edible watch,
that was
really
again. That was a really bad dad joke.
Okay, I'm going to keep them coming until
I figured you would.
Off, so.
855-935-TALK is our number. I got an interesting note. Actually, I got it today from a listener. The listeners, I don't know, somewhere in the Midwest. And he says the subject was a Fisher Christmas. Have you?
And we're not referring to the
Fisher
going out on the
Christmas.
water type of Fisher Christmas, right? Where you throw the line in and try to pull something out.
He said, "Tom and Don, I love your show," and have in fact called in. A couple of years ago, I was considering Fisher Investments, but was hesitant as it was going to take basically putting all of my assets in one basket. They were very persistent and wanted to drive to my house to meet me. I kept telling them I needed numbers, so they finally sent me these. So he sent me the numbers. And this is the first time I have actually seen numbers from Fisher.
Fisher is one of the largest registered investment advisories in the country. Mm-hmm. It's based on the work of Ken Fisher, author and asset manager, guy that I've actually interviewed on television. And Fisher uses Ken Fisher's intuition.
He's a stock
picker.
picker.
Yep, that's what I was getting at. Yeah, it's individual stocks. It's how Ken feels about different things. Mm-hmm. Your money goes in there. And here's the other part. They are easily the most aggressive registered investment advisory in terms of sales in the country. Once they've got your name, you're in. Speaking of a wild ride, you got to be persistent to hold these guys off. They are all over you.
Now, these numbers were they're a couple of years old because this guy just found them and decided he'd send them in. This was from when he was being pitched a while ago, and as he said, very aggressively. So this guy had a lot of money, apparently $1 million or more. Yep. And so they quoted him, they showed him their growth on $1 million portfolio, what it would have been. And I don't know why they picked this period. It seems a little random, but
I'm always suspicious when it's a random period.
Because it's not a 30-year period. It's not a 40-year. It's not a 20-year. It's from January 1995, January 1, 1985, through December 31, 2017. And the performance number looks pretty good when you compare it to the global index. Over that period of time, Ken's average annual return for his global total return was an average of 9% per year, turning $1 million into $7,284,000.
Which sounds great until you compare it to just a global index where you own thousands of stocks.
We're not comparing, because the global index, the MSCI index itself only did 7.3% over that same period. But
if you went to our friends at IFA.com and looked at their calculator.
And they build a portfolio very similar to the way we do it, which is overweighting small cap, overweighting value, kind of splitting U.S. and international evenly, but trying to overemphasize some of those areas that have shown higher returns. And over the same period, $1 million would have grown to almost 10 million using that indexed style portfolio, or a 10.43% average annual return.
That includes fees, too, by the way.
Yeah,
so.
Both do include fees. 855-935-TALK.
Are talking real money.
A second opinion could save your life either physically or fiscally. Let one of our Vestory advisors help you save your future at Vestory.com, Vestory.com.
For your real life and real future, Tom and Don are talking real money.
855-935-8255 is our phone number, 855-935-TALK. And, while we admire people who are fiduciary advisors, we do. We like fee-only advisors. One of the things that's unique about Ken Fisher, one, he used to be relatively famous from Forbes, back when people read Forbes. But there's a cachet to working with somebody like that. But he really does claim to be God's gift to stock pickers.
Indeed, he does, and I think that's part of the excitement that they sell. It's like, oh, now Ken's going to be picking stocks for you. You're going to be part of this family of all these people that have decided to latch on to this genius who's going to make you more. And then again, when you get down to it, they have not made more. There might have been times where it's way more exciting.
Sometimes they made more, sometimes they made less. So yeah.
But over the 20-year plus performance you just gave us, that has not been the case. So that's the thing I think people should look at. Don't get sold on the excitement. Take a real hard look at the actual numbers.
And if it makes you feel good, well, okay. You didn't get killed. 855. But that's the problem though, because he has these limited equity portfolios with just a few stocks. And you could get killed. You really could. Good thing it hasn't happened yet. But as a matter of fact, just to give you an idea, this is something to help put this whole business of taking risk in perspective. I was looking at that index funds portfolio, the IFA portfolio, which is all stocks, globally diversified, overemphasizing small cap and value, which makes it more aggressive and more volatile. And here's the thing that worries me when people get into all equity portfolios. I look at the $1 million and it grows over the course of a few years from $1 million to over $2 million by 2001. Then it loses $200,000 like that. Yeah. You lost 10% of your money like that. And then you're going, uh-oh. But then you hung in there, came back up, made it all back. Then it grew to 3 million. Then it grew to almost 4 million. Then it grew to almost 5 million. What year was that? 2007.
I'd say 2007. Yeah.
2008, 5 million to 3 million.
Yeah, I mean, this is part of the problem for people that want to be all in stocks. For one thing, you should know how much exposure you need to have stocks and to have the bonds there to sort of keep your money in times like 2008.
Yeah. So just remember, you're gonna take a hit. 855-935-TALK is our number. 855-935-8255. Bill, you're up next. Welcome to Talking Real Money. Oh, I thought it was Bill. Yeah, Robert.
Let's go to Robert.
Hey, Robert, it's your turn then. Welcome to Talking Real Money.
So hey, this is Robert. Thanks so much for having me. So my question is, I'm a college student. I'm on a budget. I want to know if there's an industry that I see that I truly believe is going to be blowing up. For example, EV batteries. How can I get into something like that with no experience and without spending a ton of money in an account?
Wait, so you want to make an investment in EV batteries? Is that what you said?
A gamble.
Oh, I see.
He didn't say gamble, but that's what I'm saying.
No, okay, I got it. How can you get in? That's an individual stock?
Well, no. Electric vehicle batteries. Go, my God.
Okay, you lost me.
You are
Okay.
a Luddite. You didn't know what an EV was?
Japan today decided that no more gas cars in 10 years.
Yeah.
Well, wow, that's a big deal. That's a big deal.
Oh, no, EV batteries are going to explode. Let me tell you the problem.
I didn't understand what you're saying.
Let me just give you the problem, Robert. You're not the only person who knows that. Okay?
Okay.
If you know it, all the people with millions and billions of dollars to invest also know it, and they've already bid the prices of those stocks up to that expectation. So in order for you to make money on EV battery stocks, they would have to go higher than everybody expects them to go. Because
Which they very well may.
But the expectation is built in already.
Okay.
You're better off. Here, how much money could you in the course of a month save and invest?
Probably about $500.
Oh, heck, that's great. Do you have a job?
Good start.
I do.
So you earn an income. This is so cool. Here's what I would do. You got 500? I would go I'd go set up an account with Acorns. All right? Acorns is way cool because you spend money. You got a credit card or a debit card, and you buy things once in a while, right?
Right.
Every time you buy something, they're going to round it up to the next dollar and put that money into a portfolio of very aggressive exchange-traded funds that will own EV battery stocks and electric car companies and Apple and other tech companies. Then the money you can save over and above that, you set up a systematic withdrawal from your checking account into what is called an Acorns Later Roth IRA.
Where they will build the same type of
They'll build the same kind of portfolio, but it'll go into a Roth IRA, which will grow tax-free for the rest of your life.
Okay.
That's how you're going to make money. You're never going to make the big killing. The big killing is something you might do at Vegas. And the odds of you doing it on the stock market are not much better than the odds of you doing it in Vegas.
Or you might start your own small business. You might create, work hard, provide a product or service that grows a lot and sell that and make a killing. That's another way. Or get into a company. You start working at Microsoft in 1985. Something like that might come along, but don't try to do it by picking an individual company or picking an individual sector or something you think will be, or we'll talk about this next hour, something like Bitcoin that you're sure is going to make you rich when it very well may not.
The failure rate is high, and you have to get incredibly lucky. And when we talk luck, we're not talking about investing anymore. We're talking about gambling. So that would be our advice to you, Robert.
Okay, thank you.
You're very welcome. Good luck, and if you keep saving, you're going to be rich. You're going to have such a comfortable retirement. If you put $500 a month away in a Roth IRA for the rest of your life, oh man!
Yes, and starting at that young age when you're in college,
you'll have over $1 million.
That's with an H too, by the way. Huge advantage over most people. It's terrific. So well done. Yeah. I'm glad you're thinking about this too. That's another thing. Most young people don't even. It's the other side of the equation. It's how much is left on my Starbucks card.
Oh, we had Robert and Bill backward. It was Robert then Bill.
Oh,
you told him to me backward. Bill, you there?
I did.
Oh, well, see, he hung up because we thought he wasn't there.
I feel bad now.
Well, you should.
Sorry, Bill. Happy holidays. Happy New Year. Hope 2021's better for you.
Robert's call illustrates something that's so normal. It's particularly normal with younger folks, which both of us were at one point. When I was in my 20s and I was working on Wall Street, I took chances. Crazy, stupid chances because I thought I knew things. And I did know about things that were going to go up. They did go up, but everybody else knew about them too. So nobody made a killing on them except the people who got in on the initial public offering or something.
And next
Even
hour,
then.
we'll talk about just one of those things that's highly speculative and people are going to get rich using it.
Or in the next podcast.
Tom and Don are talking real money.
Now everyone can meet the retirement of their dreams at Retire Meet America 2021 online. Sign up now for free at retiremeet.com. That's retiremeet.com.
Your guides to a really great financial future. Tom and Don are talking real money.
I have literally 2 seconds. Go to retiremeet.com.
We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately, consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestry, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. That's a wrap.